I'm Ashley Redmond from Morningstar.ca. I'm on the line with Michael Hasenstab, Manager of Templeton Global Bond and Morningstar's Fixed Income Fund Manager of the Year. Congratulations, Michael, and thanks for joining us.
Well, thank you very much.
So you won for Templeton Global Bond in 2010, and you're a manager in high demand right now. Much of your success can be contributed to your contrarian approach. In the last few years, you've been opting for emerging markets over developed markets. So why is this the right approach for you and your fund?
I wouldn't so much say as we've avoided developed markets. We've just been very selective, both within emerging markets and within developed markets. So, for example, within the developed market space, we favored places like Ireland. And within emerging markets, we have differentiated quite heavily between those countries that we think have good, solid fundamentals and those that maybe are a little bit more vulnerable to a changing monetary policy environment. Now, what I would say for a subset of emerging markets, countries with good growth fundamentals, higher interest rates, low levels of indebtedness, countries that are not printing massive amounts of money, those to us are a good way to help preserve capital as well as earn a decent yield when you're getting almost nothing in Canada or almost nothing in the US unless you take huge amounts of interest rate risk. So if you pick the right emerging markets, there's opportunities to actually buy very short-dated government bonds. So you're not taking a lot of interest rate risk, earn a higher yield in a currency that we think will preserve capital over a longer term. So within the emerging market universe, it's not uniform, but there is a subset that we do think is quite attractive.
And what are some examples of emerging markets that you're holding right now?
So one would be in this part of the world would be Mexico. Here's a country with very low levels of debt, reasonably attractive interest rates at the short end of the yield curve. Structurally, just recently they passed or are in the process of passing some major energy reform. They've passed a number of labor reforms, educational reforms. So structurally, the economy is getting more and more productive. They're not reliant upon portfolio capital. They've built up huge international reserves that can cushion any volatile portfolio capital that they do face when the Fed begins to taper. So they've got a good insurance policy. The fundamentals are going in the right direction, and you're able to earn a very solid yield. Turning to a place like Asia, Korea, we would argue you almost can't call Korea emerging markets anymore, but here's a country that has moved up the value-added chain. Their production, their exports in automobiles, in electronics, in the shipbuilding now compete on quality, not just price. Country has very low levels of debt, again, offers a fairly attractive yield, 3 to 4% interest rates without having to take a lot of duration risk. So those would be two examples and two of our larger overweight positions in the Global Bond Fund.
As part of your process, you and your team try to identify countries that have improving or healthy fundamentals that you believe the market doesn't appreciate. Can you tell us about any of those countries that you're interested in right now but you're not holding?
Probably, but probably difficult to share those right now. We're constantly on the lookout for new opportunities. I would say many of the countries that we've been invested in, we have been actually for quite some time. We feel very comfortable. We typically look for a longer investment horizon than most of the marketplace. Our investment horizon is often 3, 4, in some cases upwards of 5 years. So we have a lot of patience to ride out short-term volatility in order to reap those longer-term returns. But we're always on the lookout for new opportunities, particularly when the markets are volatile and particularly when there's broad-based panic. Those are great environments for us to exploit contagion, exploit panic, and pick out value for the long term.
So taking a step back, overall right now, you're managing around 190 billion assets under management. So how are you and your team able to keep pace at Templeton?
It hasn't been a problem at all. One of the few markets I think out there that has remained relatively liquid despite a lot of changes in the marketplace have been in the foreign currency markets. A $5 trillion daily liquidity market. Certainly, even though over 190 billion may be large by the landscape of our peer group, by relative to the marketplace, it's actually still very, very small. We often spend a lot of time going into these local countries to trade with domestic participants, so we're not reliant on just the financial centers of New York or London or Hong Kong, but we actually go into Seoul to transact or into Mexico City, so we aren't reliant upon some of those financial centers that have been squeezed. So with the nature of the investments we're making in government bonds, in foreign currencies, and the liquidity in those markets, managing over $190 billion has not been a problem at all.
And at Morningstar, we talk a lot about corporate culture. So maybe you could give us some insight into the corporate culture at Templeton and how it allows you to succeed.
I think our success can really be attributed to two factors. It's the right philosophy and the right people to execute that philosophy. So that philosophy comes out of a corporate culture that goes back generations. I think that's important. It's not something that's just new, but has been over 50 years in evolution. And it's one that focuses on fundamental research. It focuses on a long-term investment horizon. It takes comfort in being contrarian. And at the end of the day, as long as we're putting our clients first, it's good business. And so our team is really focused around doing on-the-ground, detailed due diligence around the world, and is comfortable to be contrarian because we do have that longer horizon. That longer horizon allows us to avoid a lot of the panics, a lot of the hype that often can whipsaw people in the marketplace. So if you can anchor yourself on a longer-term, well-researched thesis, there's a lot of opportunities to exploit out there, and that I think is really behind the success. Going out, building a large team of very skilled researchers who travel the world to unearth opportunities, and at the same time applying those people to a philosophy of a long-term approach. I think that's why we've done so well.
And it seems to be working. So congratulations again, Michael, on winning Morningstar's Fixed Income Fund Manager of the Year, and thanks for joining us.
Well, great, and thank you very much.